Hi, this is Stephen here from Share Navigator, and this is your options, futures, and spread betting trade update for November the 13th. So, we're going to start off just by analyzing our current short put position on the S&P 500. We've made a nice profit on that. We're going to look at oil. That's a trade we may place in the very, very near future. And we're also going to show you how you could place that trade in a tax-free spread betting environment. And again, that trade is going to have a high probability of success. So let's get cracking. First up then is our short put trade on SPY. Again, for those of you who are new to option trading, we basically sold an insurance policy on the S&P 500 about 6 days ago. We took in $500 per contract for basically agreeing to buy somebody else's shares of SPY, which is the ETF that tracks the S&P 500, to the value of $620. And we took in $500 in premium. So our break even on that trade is actually about $615. Now, currently SPY is trading at 683. So SPY would have to fall 10% in order for us to have to go and buy those particular shares or to start losing money on it. And the great thing about this strategy, guys, and why it's high probability, and it's very important you understand that, is that the share price can fall, it can rise, it can trend sideways, as long as it doesn't fall, in this case, by any more than 10% from here. So let's go in and have a look at the profit and loss dynamics on the trade. You can see on the right-hand side here that our current profit on the trade is $303.64. We've made actually 61% of our maximum total profit. And on the top left-hand side, you can see here there's another $195 in premium left in this put option. So remember, we want that value to go to zero. And when that goes to zero, that $195 will actually transfer over to our P&L as well. So we could make a maximum potential profit here of about $500. Now, we're going to close this trade out when it gets to about 75%. So not much longer to go. And the great thing about this trade is we benefit from time decaying. And that's the beauty of the short put strategy. So just on the left-hand side, you can see our probability of this trade being profitable is at 99% now. It's at 99%. So that's the real reason why we love this strategy. This trade, again, if you look at the P&L tables, SPY could fall 5% from here and we're still going to make money. It can go up 5%. We're making money. If it goes sideways, we're making money. So we're likely to make full 500 if we let it run to expiry, but we're actually going to close it down probably at about a $350 to $400 profit and then walk away from this particular trade. So nothing for you guys to do with this trade. Just let it run for now. And when we close it down, we will put out a video alert. The next trade I'm looking at is oil. So as you can see, we've been absolutely right to hang on crude oil. I've been saying for a number of weeks that when crude oil gets down to kind of the 60, below the 60, between the $55 and $60 level, the short put strategy is a good one to apply. And then anything above that is risky, and a number of factors. So bottom line is we had a 4% sell-off yesterday, and that was down to a report out by OPEC. And they basically said that for 2026, they estimate now that supply is meeting demand. Previous to that, they'd been saying that supply was not going to meet demand. So that obviously put price pressures on oil. And then the one thing you always have to remember with oil, and I do hope there is a ceasefire between Russia and the Ukraine, but if there is, that could have a negative impact on oil as well, as the market start anticipating Russian oil coming back to the market too. Now, our view is it doesn't make financial sense below $55 or $60 a barrel for a lot of producers to continue producing oil. So I would imagine if the price was to stay down this low for an extended period, you're probably going to get production cuts, which will basically reduce supply, and price should increase at that level. So the strategy we're looking at, we think it's too risky to go long on oil here, because we do think it could actually test this low here and even take it out at $55, $56. So what we want to do is sell a put option, which is basically ensuring the futures contract on oil. And we're going to show you how to do that in a tax-free environment as well for those who are resident in the UK and Ireland. So basically, just looking at the chart here, we're saying with this trade that, look, we're not prepared to buy oil futures now or take a long bet on it now. But if it fell, for example, another 10%, maybe we would look at it then. So what we do is collect insurance premium now for agreeing to buy that in the future. And the person who buys that put option from us, they have the kind of the peace of mind knowing that they can offload their asset if it kind of plummets further, you know. So we're not ready to place this trade just yet, but the timing is great because as you can see, the share price is falling. And as the price of oil is falling, the volatility is increasing. And we're getting paid more for premium when volatility increases. So let's go and have a look at the quotes. So we're looking here at the quotes for the December 16th put option on the January futures contract. So remember, um, these are options on futures contracts, and the first date in the expiry is the date the option expires. The second date is the date the future expires. Okay, so we're looking for deltas here, like below minus zero point 0.2. So we're at the 54 strike, and even at that, I would much prefer to go lower. So at this minute, we're probably looking at the 53. And what we'd be taking in here is about $540. So remember, these contracts are multipliers of 1,000. Just remember that, okay? It's not your typical option contract here. So if you are going to do it through Interactive Brokers, these are multiples of 1,000. Now, you can do a micro version of this, which is the ticker symbol is MCL, if you wish, which is a smaller contract. But I just want to show you what your probability of profit here in this trade is. It's 87%, as you can see. So basically, again, what we're saying is the price of that futures is not going to drop below 53 with this trade. Our break even is 52.46. So we make money. Oil is currently trading at about 59. If it fell all the way to 52.46, we're still going to make some sort of a profit. Now, look at the max loss position here. That's as if crude oil went to zero, okay? So that's the downside of doing a naked put option like the way we're doing it. You could turn this into a bull put spread if you wanted. However, because we're trading options daily, we have the ability to manage and roll this trade out and down if we wish. So we're happy enough to place it. But if you're not comfortable with that, go to the micro version. The micro version will be 1/10 of that. Or you can look at the spread betting option, which we're going to show you now. And the reason I'm showing you this first is just to highlight the probability of profit. Now, again, just a reminder, we're not ready to place this trade just yet. So hold your horses. We're going to trade it. We think that we might get a more downside pressure in oil. And if we do, we're going to get even more premium down here. And I'd ultimately like to get my strike at 52 or below, just for a bit of extra comfort. But I want that premium to come up a bit more. So we're going to hold off in this trade, but we're lining it up right now. Let's look at the tax-free option. So here's a look at the crude oil contracts in IG Index. So this is a spread betting platform. And for residents of the UK and Ireland, this would be tax-free. So the trade I just showed you on Interactive Brokers is taxable. This one would not be taxable, okay? It's slightly different how you would do it. So just a quick way of showing you. Let's say you said, right, okay, we don't think the price of that oil contract is going to drop below 5,200. You would click on the sell price here, and you can see the order window open up on the right-hand side. And basically the difference here, this becomes a bet. So let's say we put $5 a point, for example. You can see our margin on that trade will be €2,500. So we're basically saying 5 times 35.50 is what we could make here, which would be $150 in profit. As long as the price of crude oil doesn't drop below 5,200 between now and expiry on December the 16th, which is about 33 days away. So it's just a different way of placing the trade. We could change that bet to 10, for example. Our margin requirement goes up, but that means we get 10 times 35, which is $350. So remember, this trade here is going to have about a 90% probability of profit. Again, I'm not ready to place this just yet. I'm just showing you the tax efficient way to do it if you wanted. And you could put in a limit price here. So for example, if you wanted to take some of the profit away, you could say, okay, well, we'll put in a limit here at, you know, if the profit gets to, for example, if our max profit here, and this is 350, maybe we want to close it down at 175 and just take the profit off the table. So you could do all of that at once there. So that's your tax-free version of it. So that's it for your update today. If you have any questions for our members, please just reach out via WhatsApp or go to our website and go to the chat area. Thanks and bye for now.